Okay, I've got 1 minute after 10, so I'm going to get started here. For those of you I have not had an opportunity to meet, my name is Steve Van Dorn. I'm the president and CEO of the Pleasanton Chamber of Commerce. I want to thank you for joining us for our first Zoom presentation that we've done as a chamber. So I'm hoping we can do these on a more consistent basis. And I'm very pleased to have two great guys that I've known for quite a while that I think are going to be able to give us some great information on what you can do as a business owner to get through this very challenging time that we are experiencing. And so I'd like to introduce them, just give you a brief overview. The first gentleman I think many of you may already know because he has a business here in Pleasanton, Matt DePretis. And Matt is a CPA and has been one for over 30 years. And his company helps business owners get through the taxing process and accounting and any other advisory services that they may need. He's been the chair of our board. He sits on our backpack, our political action committee, and is involved in many other nonprofit organizations, also board chairman of Inklings Coffee, and a member of the Rotary Club here in Pleasanton. So Matt, so happy that you're able to join us today. And then we have Jennings Amell, who's the executive director for the Western region of the U.S. Chamber of Commerce. Jennings and I have known each other for, I think I was just trying to figure this out, for about 8 years when I used to be at the Santa Clara Chamber. And he's just a great representative for all the businesses and the chambers in the Western region. And he's going to give us a great perspective from Washington, D.C. And how this all started from trying to help out the business community and maybe talk about what we can expect in the future. So Jennings, thanks for joining us.
Thanks, Steve.
And the process here is, well, I'll keep everybody on mute. If you have any questions as the presenters speak, please type them in the chat, which is on underneath. You can find the chat icon and just type some questions, and then I'll try to keep track of those, and we'll get our speakers to hopefully answer those when they come up. So thank you all again for joining us, and I think Jennings is going to kick us off. So Jennings, the mic is yours.
Great, thanks, Steve. Appreciate it. Thanks for the introduction, and happy to be here and chatting with your members. I'll kind of just give a really broad overview of kind of what Congress has done in regards to the CARES Act and some of the other previous pieces of legislation as well that were passed to address this COVID-19 crisis that we're facing. Just to kind of set the stage, and then I'll hand it over to Matt to talk a little bit more specifically about the two programs I think that'll be most relevant for a lot of the folks that are on this call: the Paycheck Protection Program and the EIDL program, the SBA's Economic Injury Disaster Loan Program. So, but just looking at kind of what has happened in DC over the last, over now a month or so, a lot has gone on. Congress has moved very fast, especially considering it's Congress, and Congress generally doesn't move all that quickly. But of course, given the gravity of the situation here, they have moved quickly. The first thing that they did was pass an $8.3 billion kind of supplemental package that was really kind of focused on increase in research and development and more on the healthcare side. That was in the early stages of this pandemic, really even before it was officially declared a pandemic. And then, of course, in mid-March, they passed the Families First bill, which kind of was the mandate for sick leave, paid sick leave, and paid FMLA leave for small businesses of fewer than 500 employees. And that went into effect officially on April 1st. So that was a big $100 billion package that was passed by Congress in mid-March. And then, of course, the biggest package and the focus of everybody here is the CARES Act that was passed on March 27th. So a little less than 2 weeks ago, even though it feels like this thing's been around for months with the way that it has consumed our lives. But this was a massive undertaking by Congress, a huge bill, of course, $2.2 trillion, the largest package that Congress has ever passed. And it was put together in less than 2 weeks and pretty phenomenal, especially considering the fact that the Senate led the charge on this. And the Senate, of course, does not typically move very quickly on anything. But to put this together in less than 2 weeks, $2.2 trillion, it's about 10% of the nation's GDP. This is a 900-page bill that was put together very fast. And so there's still a lot of issues that need to be worked out. And we've still been looking to Treasury and the SBA for additional guidance on some of these things. And in particular, the rollout of the PPP, the Paycheck Protection Program, has been a little rocky, but I think that that is to be expected given how fast everything moved. And the fact that we didn't see our guidance from the Treasury until last Thursday night, and banks were expected to begin accepting applications on the PPP from sole proprietors and small businesses on Friday morning. So they had very little lead time. They really had to kind of rush to put this together. And so as we would expect with the program that was rolled out this quickly, we have seen a lot of issues and a lot of uncertainty from banks as to what exactly the guidance is and what their liability is and all of these issues. And then small businesses really just kind of clamoring for help because just about every business in America has been impacted by COVID-19. And so trying to take advantage of that PPP program and then also the SBA's EIDL program. And we've also seen the SBA, of course, be just totally inundated with applications. So we've seen issues with lag time and hearing back from the SBA. And I think that these issues are certainly understandable, but hopefully they seem to be moving in the right direction with each and every passing day. The program, I think, a lot of these kinks are going to be ironed out and the program will begin to run a little bit smoother. And so hopefully we'll continue to see that happening and business should be assured or should at least have the confidence that they will be able to get access to either one of these programs, or that there are programs that are out there. And really Congress's intent with doing the CARES Act was to make sure that they immediately or as soon as possible reestablish liquidity into the system, understanding that we have a liquidity crisis for small businesses. So how do we get money pumped back into the system as quickly as possible, make it as accessible as possible for businesses? That was a massive intent here and underlying motivation for Congress. And then the other motivation, of course, is to keep people on payroll. How do we make sure that we not have so many people filing for unemployment all at once and just overburdening our state unemployment systems, and keeping people on payroll so that they can continue to get their health insurance through their employer. And that also, so when we get through this crisis in a couple of weeks or a month or whatever, however long it's going to take, that these employees are still connected to their employer, and that there will be a seamless transition to kind of try to get back to business as usual and get businesses up and running again. And so that was really the overarching kind of intent of Congress, was to do that liquidity and make sure that folks can stay on payroll and be continued to be connected to their employers. So that's what we've seen with this bill, even though it's not perfect and there are a lot of issues, like I said, that need to be worked out. Certainly that's the intent here. And in regards to the small business program, I do think that Congress was kind of caught off guard a little bit by the fact that, looking at the numbers over the weekend and how many folks have applied for that PPP program, it does look like it's on pace to potentially run out of money. And so Congress is attempting to address that issue now. And we saw today there was an attempt to do a vote by unanimous consent in the Senate to add add $250 billion to that small business program. That ultimately failed, unfortunately. The Republicans, or Majority Leader McConnell, attempted to move that package just with an additional $250 billion, and that was it. Senate Democrats had kind of insisted on adding a couple of other things, such as additional funding for hospitals and for states, and then also making sure that a portion of that money would be devoted towards minority-owned businesses, women-owned businesses, veteran-owned businesses, things like that. So that was kind of the hang up today. Hopefully, though, we'll get past this and Congress will infuse the amount of money that's needed to keep the PPP program alive and make sure that small businesses can continue to take advantage of it. And then, after that, I assume at some point later this month, we'll have an even broader discussion on other things that need to take place with a larger kind of phase 4 package. And that'll require Congress to come together. And I don't know how they're going to work that out going to DC, because every day you have a vote in DC, it's like pulling together a concert. So that'll be difficult to do, and remains to be seen how they're going to work that out. But That's kind of the state of play right now. And just wanted everybody to understand the overall intent of what Congress was doing with the CARES Act and making as much money available as possible for businesses and keeping folks on payroll. Those are kind of the underlying intents there. And then we'll see kind of more action, I think, in the next couple of days and weeks from Congress to address some of the outstanding issues. But the PPP program, EIDL program, obviously hugely important. And I'll hand it over to Matt to talk a little bit more specifically about the details in each of those programs.
Thanks, Jennings. Before you start, Matt, just we've had a few people join us. Just if you have any questions, just go to the chat button at the bottom of your screen and type it in, and we'll try to get those covered. I'm going to keep everybody on mute just so we can get through all this great information that Matt and Jennings will be sharing with us. So thank you, Jennings, and Matt, it's all yours.
Thanks. Start off, I just do want to acknowledge the financial pressures that business owners, like folks on this call right now, are facing right now. And I do want to say thank you to the Pleasanton Chamber of Commerce and the U.S. Chamber of Commerce for getting out ahead of this and providing resources and guidance to really help us get through this tough time. So I just want to say thank you to them. Right now, as business owners, it's hard to know what to focus on when there's so much going on, and really right now we need to be focusing on liquidity, and that's what the whole CARES Act is about. And as you know, cash is the lifeblood of a business, and when you're out of cash, you're out of business. And so it's all about liquidity. There's two things that I think we should really be focusing on. One is developing a cash flow projection, and two is finding ways to stay liquid. Developing a cash flow projection, we really need to know how long our cash is going to last. Where are we going to, how many days, how many months do we have left? It seems like maybe we don't want to know that number, but ambiguity creates anxiety, and it's just good to have a number there, know how long we have so that we know how to go to battle against it. Second thing is finding ways to stay liquid. And there's some tough choices to make regarding cutting costs. There are some creative ways to find alternative revenues. And then there's looking for sources of cash outside of our businesses. And that's what we're talking about today, is through the government stimulus package. As Jennings mentioned, a lot of things have passed in the last 4 weeks, and it's happened fast, and it's a lot, and so it can get pretty confusing to kind of decipher through all that. So hopefully today we will bring some clarity, and we welcome your questions. And so I'm going to start off by talking about the SBA loan programs. As Jenner said, there's basically two programs. One is the Payroll Protection Program, the Paycheck Protection Program, and that's a new program. It's a temporary program. It's between now and June 30 that you can apply for that. The second thing is the Economic Injury Disaster Loan, and that program is an ongoing program, but it was enhanced for this year for the coronavirus through December 31. I'm going to share my screen and go through a few notes, going a little deeper into how some of these loan programs work. Okay. Can everyone see that okay? I guess you can't talk, so I can see it just fine. Okay, so let's start off with the Paycheck Protection Program. Is really, it starts off as a loan that may be fully or partially forgiven, available through June 30. And the purpose is to incentivize owners to keep employees on the payroll or to rehire them back. And I'm just going to ask a series of questions to answer, to get the dialogue going. Who's eligible? All businesses, nonprofits, and independent contractors with 500 or fewer employees. Affiliation rules do apply, and the reason why I'm talking about the affiliation rules is that affiliation is based on common ownership, common management, and a few other things. And when you look at these rules, you may have 500 employees when you didn't realize it. So it's just something to go through when you're looking at eligibility. And a lot of this I'm kind of going over on a real cursory. We can go into more detail with questions. How do we calculate the amount? And I'm kind of just starting here because there is some confusion about this. Because as we're talking with clients, there's first of all, there's a loan amount, and there's also a loan forgiveness amount, and those are two different numbers, and that is causing a little bit of confusion. And so you compute the loan amount first, and then you compute a forgiveness amount that is applied against the loan, and at the end, you may or may not have any loan left over. So how do we calculate the loan amount? I'm going to go simple and then go into more details. First of all, it's the lesser of A or B that you see here. The lesser of the sum of your average monthly payroll costs times 2.5 plus any outstanding economic injury disaster loan that was made between January 31st and April 3rd, less the $10,000 grant if you received any. For many folks on the call, you may not have any of these loans yet, so it's really the average of your monthly payroll costs times 2.5. So it's the sum of that or 10 million, whichever is less. So what goes into payroll costs in that calculation? It includes basically all or most compensation. It's salaries, wages, commissions, tips, vacation pay, holiday pay, sick pay, leave pay, separation pay if you're paying someone out as they take off. It also includes group health insurance, retirement contributions, the employer portion of state taxes. So it does not include federal taxes or employee taxes, but the employer portion of state payroll taxes. And also, if your business uses a professional employer organization or you lease employees, that is okay also to put into this computation. Now, what we've been finding in working with clients is that many clients and banks are not computing this correctly. We found in one case a bank used box 1 of your W-2. Well, that's a net number. You really need to use box 5 of your W-2. So we're seeing errors like that. One thing we are seeing in order to make this a little easier is several of the larger payroll services are also providing reporting specifically to the PPP loan in order to just make it easier for their clients. So that's something you may want to look at with your payroll provider. What items are excluded from the payroll cost computation? Annualized compensation in excess of 100,000, employees residing outside the US, and independent contractors. And we'll get back to independent contractors later, but right now you may have employees and contractors on your payroll. The independent contractors are not included in this computation. The next question is, what time period do we use for averaging? Because it's the average monthly payroll costs. Well, according to the guidance we've received, we can do it 2 different ways. We can use the trailing 12 months, April 1st of 19 through March 31st of 20, or we can use the calendar year. Now, in practice, what we've been finding is that banks, each bank does it their own way. So we've been recommending to our clients when they're preparing for these loans to just prepare both ways unless they already know what their bank is which way their bank is asking. Seasonal businesses or businesses that were not in business the entire year, the calculations are a little different on averaging, and so we can get through that as well. So documentation, what's necessary? The SBA is actually saying that they only need the application, the SBA application 2483. In addition, they're asking this loan is processed through your bank, which we'll talk about in a second. So the SBA is saying all we want is this application, and it's up to the bank to get whatever other necessary documents they need. And basically, it's payroll documentation. We are finding that banks are asking for all kinds of different things, and we've had to push back a little bit. And but the bank needs to get comfortable with the documentation. Banks are, according to the guidance, banks are not required to recompute a borrower's calculation that we're talking about, or audit any of their documentation. They only need to look further if something looks odd. And that's according to the guidance. Again, in practice, it seems to be different bank to bank. And so let me just show you briefly while we're on the topic what the payroll protection program application looks like. It is it's a very short application. It asks here's your average payroll here. Here's the 2.5 times you have your number of employees. And it's very, very little information. You have to say that you're not a criminal, things of that nature. I'm not sure I could answer that one truthfully. Just joking, sorry. It's really hard with an audience when they're all on mute. So anyway, I'll keep going. But it's a pretty short application. The reason why I'm showing you the application also is because some people have contacted their bank. They have signed in online and think that they have applied for a loan, but they really haven't yet. They've only signed up to apply, and each bank is a little different. And so I just want to help guide you through that a little bit. Okay, so we just went through the how you compute the loan, and that's what we're focused on right now, is computing the maximum loan for each business. Second is the second calculation. This is how we calculate the amount forgiven. Now, the amount forgiven we won't really calculate until 2 months from now, after we receive the funds, and we're trying to maximize the amount forgiven. But let me go through what the calculation is. And it's really two parts. First, it's the sum of some costs. And then secondly, it's how those costs are possibly reduced. So let's just go through this. First of all, you take the sum of the following expenses for the 8-week period beginning on the date the lender makes the first disbursement. So as soon as you get the loan, an 8-week period begins. And during that 8-week period, you look at these 4 items. Number one, it's payroll costs. And we've already defined those payroll costs. It's the same payroll cost as we looked at earlier. Secondly, it's interest on facility mortgage, it's facility rent, and it's utilities. And you add that all up, and if you have nothing else to deduct from that, then that is the amount that you use to deduct against your loan. And for many businesses, that will fully erase the loan. For other businesses, it's only going to be a portion, and there will be a loan amount left at the end. So what reduces this bucket of costs? There's a number of things, and it gets a little confusing. So let's just go through it slowly. First thing is in that bucket, the non-payroll costs in excess of 25%. So the non-payroll costs are the interest on mortgage, rent, and utilities. If those amounts exceed 25% of this calculation we're doing, of this 8-week period, that portion gets lobbed off. Secondly, if you have received the $10,000 advance under the EIDL loan, that gets lobbed off. Next is the number of full-time equivalent employees you have. If the number of full-time equivalent employees have reduced during that, we'll just have been reduced from the prior year, the percentage of the decline, let's say that your full-time equivalents are down 10%, then you lob off 10% off this amount. So that's the number of employees. The second is salary. So if you have employees that earn less than $100,000, if their salary, this is on a per employee basis, if their salary is reduced by 25% or more, then we use that percent deduction in order to reduce this 8-week pool of funds also. Now, having said all that, if an employer replaces their full-time equivalent employees and restores their reduced wages by June 30, the full forgiveness is again allowed. So we're really working to get back up and running on June 30, 2020. So that's a big date. I don't know if they'll change that date or if there's been changes to the program in the last couple of weeks, but this is where we're at today. And so my last statement is good planning is necessary to maximize the amount forgiven, because as you can see, there's a lot of moving parts here, and really planning well on when to bring your employees back, how much to pay them, keeping your payroll costs up, things like that's the push of this program, is to get your employees back in service. And we do expect more guidance on this computation in the coming weeks. Okay, so we have our loan amount, we have our forgiveness amount. If the amount forgiven doesn't wipe out the entire loan and you have a loan balance remaining, what do we do about that? Well, here are the terms of that loan. First of all, it has an interest rate of 1%. It's amortized over 2 years. There are no prepayment penalties. So if you have amount left over, you don't need it, you can pay it back. There is no personal guarantee, no collateral, and the first payment is deferred 6 months from the disbursement date. So it does give you some cushion on making any payment on the loan. Even though the first payment is deferred for 6 months, the interest will accrue during that period. What about independent contractors and sole proprietors? So we're hoping for guidance on this because they're supposed to start applications tomorrow. We're hoping for guidance today. 20 minutes before this webinar, I looked and we still don't have guidance. So we're hoping any time now. But in just a real nutshell, if you're an independent contractor or sole proprietor, you look to your Schedule C, and the loan is, the calculation for that loan starts at the bottom of your Schedule C. So, okay, so when do we apply? Businesses, it started last Friday, and independent contractors will be starts tomorrow. Where do we apply? And I know Jennings has talked about this a little bit, but first thing you want to start off is with your own bank. And most banks are SBA approved, so your own SBA, you want to start there because a lot of banks are not taking on new clients. And if they are taking new clients, they are prioritizing their existing clients. We even had some banks say they don't want to work with their own clients if you already don't have a loan, currently have a loan, or haven't had a loan with them in the past. So banks are all over the place on being prepared. And so it's really a bank by bank. This last, I was telling a few folks especially this, I guess it's been a week. I don't know how long it's been. It's all big one day for me, but been networking with a number of CPAs across the US. And, we're working really hard to get all ready, and we want to get our clients up and running and going, and only to find out that last Friday when we're ready to go, the banks weren't ready to go. So, and it's understandable, but there was a lot of panic of getting in line to get your loan in line first, so that before you ran out of money. But I will tell you, I don't know of anyone who has been funded yet. I know that there's applications that have been approved. We've had loans approved. We have loan numbers, but I don't know of any cases where it's actually been funded. I'm not saying there hasn't been. I'm just saying I haven't seen it. Same thing with the. We'll talk about that later. We'll go down to the bottom of the slide. Will the funds run out before business is funded? Jennings talked about that. We're hoping not, and hopefully Congress will allocate more funds if necessary. But I still feel that if this is something, I think that most businesses right now really need to look at this hard and take advantage of this for their own liquidity if they need it. I did list a few banks here that I've heard are taking new clients. Lendio is an online bank. I'm not recommending these banks. I've just heard that they're taking new clients. Silicon Valley Bank, I've heard, is taking new clients, and Harvest Small Business Financial are taking. In addition, Heartland Payroll Service. Many of you may know Ursula Beal with Heartland. They are working with a credit union and helping their clients get set up with that credit union. I think, Steve, you heard of a few more banks as well.
Yes, this morning on a call, there's a website called Kabbage, KABBAGE.com. Several of our members were able to get applications into them. And then another company called Bowfly, BOEFLY.com. Also, one of our members worked with them as well.
Good, thanks, Steve. Okay, so that was the Paycheck Protection Program. Let me go through the Economic Injury Disaster Loan Program. First of all, this program, it's for loans up to $2 million for businesses with fewer than 500 employees to meet working capital needs or normal business operating expenses when there has been a qualified disaster, and the COVID-19 is a qualified disaster. Current loans are available through December 31, or at least this program is slated through the end of the year. And I'm sure a lot of news has been, it's been in the news a lot, this $10,000 grant. It's a loan advance up to $10,000 that may be granted, that does not need to be repaid even if the loan is denied. Again, we have not heard of anyone receiving that 10 grand yet. So far, it appears to us is that when you go online to the SBA, because this goes directly through the SBA, you go through some few different screens. You sign up for some things, but you're really not signing up. You're not applying for a loan. You're applying for a spot to apply at some time. I think that the SBA, and it's understandable, is overwhelmed with the number of requests. And so it just, this is like the biggest wealth transfer in our history. And, it's going to take some technology and some time to get through that. So right now we haven't heard of anyone receiving that grant. Now this whole loan is different from the PPP loan in that the PPP loan is offered through banks. And once it gets going, technically a bank has the ability or the approval from the SBA to approve the loan the same day and fund the loan within 48 to 72 hours. In practice, that may not be happening, but once the banks get going, maybe that will happen a lot better. The economic injury disaster loan is more of a traditional loan through the SBA, which takes a lot longer. And that's why they're offering this $10,000 loan advance, just to get money into people's hands while they go through the entire loan process. The terms on these loans are an interest rate of 3.75, amortized over 30 years. There is no personal guarantee required for loans up to $200,000. However, collateral is required, which is different from the PPP loan. When should you apply for the PPP, the economic injury disaster loan, or should you apply for both? And on the PPP, it's all around payroll. It really depends on where you're at. The economic injury disaster loan is when you have significant non-payroll costs. You may want to take a look at this. You can also apply for both. The only thing you want to be aware of is that if you apply for both, you cannot use the same expenses for both, meaning that if you're going to use payroll, mortgage, rent, and utilities for the PPP loan, you have to pull those expenses out when applying for the disaster loan. Also, just as a note, if you do receive the $10,000 advance, it reduces the loan forgiveness by the same amount on the PPP loan. And finally, what I did here, and these are my notes, I think you'll have access to them, but we put together a chart showing traditional SBA Section 7A loan compared to the payroll protection loan and the economic injury disaster loan. So you can compare the different terms and aspects of them. Steve, at this point, that's where I really have for PPP. There are some other payroll tax credits and things, but maybe we should see if there's questions on this, and I don't want to take up too much more time.
Great. Thank you so much. That was really, really well done. It's nice to see the chart. And as someone asked on the chat, we'll get, hopefully Matt agrees and he'll share this with me, and we can get this on our website, pleasanton.org, the chamber website, so you can have access to it and print it out and use it for your business. I don't have any questions right now, Matt, so I'd like to just defer to Jennings. Jennings, do you have anything to add to what Matt has said that would be helpful? Get your mute. Your mute's still on. Oh, yeah.
Yep. No, I don't think so. I mean, he did a great job of covering over most of the details of the program. So nothing to add on those two programs.
Okay, great. So I guess we're now going to talk a little bit about the tax relief, business tax relief, and give you some tips on that. Matt, I think, got this one too, right?
Yeah, I'll go over real briefly. I know taxes can get pretty boring to people, so I'll try but I think there's some great things that we want to talk about. So so first of all, there's two payroll tax relief inside the CARES Act, and really, I'm just going to put a big caveat in here. There's one called the Employee Retention Credit and the Payroll Tax Deferral. They're both great things. However, If you are granted a PPP loan and get the forgiveness, neither one of these count. So if you end up not getting the payroll protection, excuse me. That's the first cough. Sorry for joking. So, wow. Take one more drink, sorry. Okay. If you end up not using the payroll protection program, here's two good things. One is you can take the employer's share of payroll taxes, your Social Security taxes. The employer pays 6.2% and the employee pays 6.2%. You can take that, the employer share equal to 50% of qualified wages paid to each employee on a quarterly basis, and you can take that as a credit for the remainder of 2020. The compensation used to compute the credit is limited to $10,000 per employee. So really, to max this out, you could get a credit of $5,000 per employee per year if the following: if you have had to either partially or fully shut down due to shelter in place, or the government limiting commerce, or your gross receipts have fallen below 50% in that same quarter. So this is pretty powerful. Also to get $5,000 credit per employee potentially. Second thing is a payroll tax deferral. And after reducing your payroll taxes under the emergency sick and family leave credit, which you may or may not have, looking at the numbers, there's in Alameda County, there are very few sick in comparison to the rest of the country. So there is a credit for paying sick leave in an emergency. But after reducing your payroll taxes for that and the above credit, anything remaining, any other Social Security tax on the employer side can be deferred to 2021 and 2022. So those are both really good tax relief. Then, let's see. Then I'll just go through some highlights of some income tax relief. First of all, the net operating loss carrybacks have been enhanced. So we can now carry back 2018, 19, and 20, can be carried back 5 years to 2013. There is maybe some strategy here. If you have not completed your 2019 returns yet, maybe you want to consider trying to create a loss in 19, carrying it back to expedite a refund. We already know 2020 is going to be a tough year for most people. There's probably going to be losses in 2020. But if we can, there are some things you can do to increase your deductions. And so there may be some strategy to do with that. There is a business interest expense limitation that has changed. Corporate minimum tax credits have been changed. They're fully deductible for 18 and 19. For individuals, if you are under 59.5, you normally pay a 10% penalty from a distribution from a qualified retirement plan. For the entire year of 2020, you can take up to $100,000 this year and not pay that 10% penalty. You will owe tax on it, but you won't have the 10% penalty. In addition, if you're over 70.5 and you are required to take minimum distributions from your retirement plan, those are completely waived for 2020. Charitable giving, there's been some changes. For people who take the standard deduction and you give to charity, doesn't do a lot for you. So they've added a $300 above the line contribution for people who take the standard deduction. The charitable contribution limitation for individuals, normally it's 60% of your adjusted gross income. It's been raised to 100% for 2020. And employers are permitted to contribute up to $5,200 toward an employee's student loan without causing W-2 income for that employee. So that can be a real good benefit for employees. Those are some of the highlights that came through the CARES Act. On the slides also, I do have some resources that to send you to. And so that's it, Steve.
Great. Thank you, Matt. I'm not seeing any more questions from that as well. Thank you. That's very interesting. And Jennings, did you have anything to add to the tax relief stuff?
Just Matt, I don't know if you wanted to touch on too the qualified improvement property issue that was kind of cleaned up as well. I know that that's kind of been something for retailers and restaurants that's been important. That issue, and then on the employee retention tax credit, the different rules for employers with 100 employees or more and 100 employees or less than 100 employees. I don't know. Did you want to touch on that?
I just prepared for just a few of the highlights. The qualified leasehold improvements on the last tax bill. There was an error on that bill, and so we were not able to accelerate depreciation for certain restaurants and retail. And so as they're putting the CARES Act together, they were able to fix that. So that was a big thing.
Yeah, absolutely. Yeah, we heard a lot of frustration from that sector after the tax bill went into effect, and we realized that drafting error was there, and a lot of people were surprised. So it's good that was fixed anyway.
Yeah.
Great. Well, I'm not seeing any questions. Thank you, gentlemen. I guess we've got a little bit of time to talk about any employee issues such as sick leave, family leave. This gets really complicated, and there's so many different, I've been on several webinars, people talking about this, but maybe you can just give us kind of a overview of some of the major changes that some employers can take advantage of with these changes on the families first. And Jennings, why don't you start off this time?
Sure. I'll just I'll share my screen as well. I've got 2 slides on this, so it might be good just to have kind of a visual. I'll try to put it in. There you go. So on the Families First bill that was passed in mid-March, of course, that was a $100 billion package that dealt with paid sick leave and family medical leave. And that applies to employers with less than 500 employees, as well as nonprofits. This went into effect on April 1st. And so that they would be required to provide 10 days of paid sick leave if the leave is related to COVID-19. So it has to be COVID-19 related. So essentially, when you have someone that is ill or quarantined due to exposure, or advised by their physician to self-quarantine, or if they have to take care of a family member who's been quarantined, or have to take care of a child that is now staying at home due to school closure or daycare closure, they would be entitled to 10 days of paid sick leave. The leave would be paid at the regular rate of what they get paid, with the maximum of $511 per day and $5,100 in the aggregate. And then it'd be a 2/3 rate, the maximum of $200 per day if caring for a family member. Now the payment for the sick leave would be, you'd be able to get that back from the federal government and reimbursed at 100%. So there is a tax credit available. And I believe that businesses, if they obviously don't want to wait to receive this money, that they could apply directly to the IRS to receive the credit up front. And you can find more information on the IRS's website. I believe that went live just a few days ago. So you can find more information there on how to go about doing that. And then it's important to note too that this sick leave requirement is in addition to whatever the employer already offers or whatever is already mandated at the state level, for example. So this is an additional 10 days on top of that. Also important to note that for businesses with less than 50 employees, they may be exempt from providing sick leave for an employee who has to take care of a child. So this is only for an employee that has to take care of a child due to school closure or daycare closure. If that business can prove that providing that sick leave threatens the viability of the business. So this is something that if you are a small business with fewer than 50 employees, you'll want to document as to why that would threaten the viability, and just kind of make sure that you have that paperwork in order, for auditing purposes, things like that. The paid sick leave, of course, is not available if the employee is capable of teleworking. Same thing goes for the FMLA, a lot of the same requirements. Once again, this is for small businesses with fewer than 500 employees, as well as nonprofits. They would be mandated to provide 10 weeks or up to 10 weeks of paid FMLA leave on top of those 2 weeks of sick leave. So once the 2 weeks of sick leave expire, then you have the 10 weeks of FMLA leave. And once again, this has to be COVID-19 related. The employee is staying home because of self-quarantine or issues with COVID-19, or taking care of a child or family member, due to a school closure or closure of the daycare. Now, the leave for this is paid differently than at the sick leave. So it's not at the regular rate, but it's at 2/3 of the regular rate, with a maximum of $200 per day and $10,000 in the aggregate. And once again, just like the sick leave, this is in addition. To any FMLA leave that is already being provided by the employer, or what's already mandated at the local or state level. And also similar to the sick leave provision for employers that have less than 50 employees, they may be exempt, once again, from providing this FMLA leave to their employees that have to stay home to take care of a child, if they can once again prove that providing such FMLA leave threatens the viability of their business. And of course, just like with sick leave, this paid leave is not available for an employee if they can telework. So those are the two issues, the FMLA and sick leave, that were part of the Families First Act that was passed a few weeks ago and went into effect on April 1st.
Thank you, Jennings. I've got a couple of questions that came up. One is on the 10K possible advance through the EIDL loan. As I think was mentioned, we were promised that we would get that in 3 days after application. And as I mentioned earlier, we submitted ours at the chamber a week ago, and we didn't receive any response. We haven't received a response to date. So this gentleman's asking, is that 3 days just not going to happen? So Matt or Jennings, can you guys answer that?
So it's my understanding it's 3 days from your application. But I'm not certain anyone has filed an application yet. I think what we've done is filed an inquiry for an application. That's the difference.
Okay, got it.
And then also too, what I've heard from some folks, some of my colleagues that have been talking with SB folks in other regions, is that I guess they've been saying it's 3 days after the applicant has received an email from the SBA that the application, I guess, was approved. So it has to do with that email timeline of when they receive the confirmation email from the SBA within 3 days of that email. So there's all kinds of different information going around, but that's also what I've heard.
Great. Another question was, does the employer have to allow sick leave to be utilized for shelter in place and teleworking is not available? I've heard this question before. So does that make sense? Go
yes.
Ahead. Yeah.
Yes. I believe so, because shelter in place, it's COVID-19 related. I believe that they would provide that. I could double check though. I don't know if Matt, if you've heard otherwise, or.
No.
Okay.
I've not heard otherwise.
Yeah, I believe because that would be COVID-19 related, that yes, you'd have to provide the sick leave, and if they can't telework, of course.
Right. Okay.
But there is a distinction between shelter in place and sheltering because of a doctor's mandate.
Correct.
So there's a difference between that.
Yeah.
Let me look into that though, just to make sure, because I don't want to give false information. So I can look into that and confirm.
Yeah, what I've heard on some of the webinars I've been on with Hoag Fenton is that that shelter in place, just because of the government setting that up in the counties, that is not, you do not receive sick leave because of that.
Yeah.
But that's what I've heard. Again, I'm not an expert, but if you're sheltering in place because you are infected or you think you have COVID, then it is covered.
Yeah.
Another question that I think we've answered, but I'll throw it out there. Can I apply for a PPP loan as a sole proprietor? I'm an independent contractor inside a business.
Yes, and that starts tomorrow. And again, we're waiting for more guidance on how that calculation happens. But basically, the bottom line on your Schedule C is the basis for the start of that calculation.
Okay, Jennings, anything to add?
No, I think that's right.
Great. Okay, another question. On the PPP application, is there a place to list rent on the application?
That's a good question, because there's this confusion between the loan computation and the debt forgiveness computation. And so the application is just about the loan. So there is no rent. I mean, there's some boxes that you can check to say, hey, I'm going to use what you're going to use it for, but the calculation is just for payroll. Then on the back side, what we're doing is we're adding the rent, mortgage, utilities to the payroll for the loan forgiveness. So it's two different calculations, and it is confusing.
Thank you. Jennings, anything to add?
No, that's right.
Okay, great. Well, I don't have any more questions. We are just, boy, look at that, 10:58. We're almost at an hour. Again, I want to thank Jennings from the U.S. Chamber, Matt DePretis from DePretis CPAs for being here. Great presentation. Now, I want a few questions about where you'll be able to find this information. We'll be posting it on our website under Business Resources. If you go to our homepage, there's a button on the left that says COVID-19. We will present or post the recording as well as the presentations. Hopefully Jennings and Matt are okay with sharing that with me. Yeah. And then I will also include those two resources of companies, banks that we've heard are allowing for new loans that are not currently clients. So anything to close out, Matt and Jennings?
No, thank you for having me on your show.
All right. Yeah, no, same. Thanks, Steve. And, thanks for everything that you're doing. And I think that, difficult times like these really have shown folks in the business community the value of chambers as the ultimate resource for this kind of information. So thank you for everything you're doing.
Thank you, guys. Well, happy Easter to everybody. And I appreciate you listening in today. We'll be in touch for our next one soon. Take care.
Thank you. Thanks, Matt.
Take care, Jennings.
Thanks, you too.